David Burrows of Barometer has brought with him 3 fresh top picks. Top pick number 1, we talked about you didn't like Canadian bank stocks. So why would a Canadian demutualized life insurer be something you would like?
Okay, so our job as investors is to go to where the puck is going.
All right, Gretzky.
Okay, Gretzky. We are in a world where we were at 300-year lows in interest rates. That's a challenge for an insurance company. We were in a world where you had very uncertain equity markets. That's a challenge for an insurance company. We were in a world where people weren't overly aggressive in making wealth management decisions. Not so good if you're in the wealth management business. Manulife has gone through a period of time where they've had to fix their balance sheet, which they did. They have grown outside of the Canadian border. U.S. is their biggest market. Asia, very strong in behind that. Wealth management is a big part of their business. We now have slowly rising interest rates, we believe. We have improving capital markets, which I think will go on for some time. Insurance companies are the biggest beneficiary of rising interest rates. And Manulife stock, you look at it trading in New York, made a new high yesterday. With a lot of other insurance companies in that same theme, okay? So when we look at insurance companies like Manulife are likely to grow their earnings double digits for the next few years. That's not going to happen, I don't think, in the Canadian banks. They're not terribly expensive. You're going to get good dividend growth because the capital positions have been rebuilt. So this is a play on global wealth management. It's a play on the U.S. It's a play on rising rates. And after the stock traded sideways for really 8-9 months, it's breaking out to new highs. So this makes it very attractive to us, especially for Canadians who are looking for some Canadian exposure, but still having outbound exposure outside of Canada.
Putting your money where your mouth is on the suggestion to our callers that you would want to buy American financial services stock. Citigroup is top pick number 2. This one's trading at what looks like to be about a 20% discount on its price to book alone.
Right. So we've recommended Wells Fargo. We've talked about JP Morgan. We've talked about a number of financials. Citigroup, I think, is probably the best positioned right now. First of all, their asset quality has been improving, and you can tell that by looking at the price of a credit default swap or the risk that people perceive that they have real risk in their bonds. That's been getting much better. They have been focusing on their core consumer business, the credit card business, where the U.S. economy gets better, the credit card business gets better. As rates go higher, that's good for them because they make money on the float. It has about 50% of its revenue coming from outside of the U.S., so it's an investment in slow global recovery. And it's inexpensive relative to its peers. I don't tend to look at things, just are they cheap? Are they inexpensive but have catalysts to make things get better? So we think we're going to get really good dividend growth here. We think that as the economy gets a little better and rates go higher, they benefit. And I think that there's a lot of drivers in this stock.
Top pick number 3, I can't imagine, is for the dividend. FedEx has less than 0.5% as a payout.
Yeah, so one of the big secular themes, and we've seen it, every social media company is adding a buy it button.
Right.
Right? So that means that there's a lot of stuff going to have to get shipped. Now, FedEx, big business, is business to business. And businesses in general are doing exceedingly well, and business is growing around the world. So we're comfortable with that piece of it. On the cost side, they've been cutting costs. They've got another $1.6 billion of costs they think they can get done by the end of next year. So they're cutting their costs. But 25% of their business is the ground business, which is really their consumer business. And consumer retail sales online are growing 3 times the rate of retail sales in general. So that business should grow. It's in a sector that has pulled back recently, but FedEx didn't. FedEx is trading right at the highs, which tells you it's really one of the strong ones in the group. People have talked about transports being negative because the rails have backed off on the back of weak energy. But I think FedEx wins from stronger business, stronger consumer, and the Internet of Things.
David, it's always great having you with us. Thank you for coming back.
Thanks for having me.
David Burrows has been our guest, President and Chief Investment Strategist at Barometer Capital Management. Again, that's Manulife Financial, Citigroup, and FedEx. That is it for this edition of Market Call. The encore presentation airs Monday through Friday, 10 p.m. Eastern, 7 o'clock Pacific. And you can join Mark Bunting Monday through Friday, live at 6 p.m. Eastern for Market Call tonight. I'll be in this chair again tomorrow. Please don't send in the complaints. Mark will be back on Monday. As always, please consult a qualified financial advisor before making any investment decisions. We hope to have you Be with us next time. I'm Michael Lansman.